Right, so you've heard the terms derivative trading thrown around, but what does it actually mean? Let me break it down for you in plain English. A derivative is basically a contract, nothing more, nothing less. Its value comes from something else like a share, gold, oil, a currency, or even a market index. It doesn't have value on its own, it's always linked to something underneath, which is why it's called a derivative. When we talk about derivative trading, we're talking about buying and selling these contracts, not the actual asset itself. Why bother, you ask? Well, people trade derivatives mainly to hedge risk. Think of it like insurance against price swings, or to speculate, meaning they're hoping to make a profit if the market moves their way. And sometimes it's just a way to get involved in markets or assets they otherwise couldn't touch. There are four main types of derivatives you'll come across. First, there's futures contracts. These are agreements to buy or sell an asset at a set price in the future. Then, options contracts. These give you the right, but not the obligation, to buy or sell something at a certain price before a deadline. Swaps are a bit more niche. You're swapping cash flows or liabilities, often to manage interest rates or currency risk. And finally, forwards, which are customized deals traded privately, not on an exchange. Let's make this super clear with an example. Imagine you're a farmer, and you're worried the price of wheat might drop before your harvest. You could enter a futures contract now to lock in a selling price, taking the uncertainty away. That's hedging. On the other side, a trader might buy your contract, hoping wheat prices will rise so they can sell it on for a profit. That's speculation. The key is, neither of you is trading actual wheat, you're trading the contract. So where do these trades happen? On big exchanges like the CME in Chicago, the NSE in India, or the ICE. Or over the counter, meaning deals are made privately, with more flexibility but more risk. Now let's be honest, derivative trading isn't for everyone. Sure, there are benefits, risk management, leverage, and market efficiency. But the risks are real. Big losses, complicated pricing, and high volatility. If you're just starting out, steer clear until you really know your stuff. To sum up, derivatives are contracts tied to other assets, and trading them is all about managing risk or chasing profit. They're powerful tools, but not without danger. Thanks for sticking with me. If you found this helpful, do share it or use it for your own learning. Until next time, keep learning and stay sharp.